Yeah. Well, in crypto, the best years are definitely ahead because today there's only 4 million Bitcoin wallets with $10,000 in it. There's 900 million IRA and brokerage accounts globally that have $10,000. So that's 200 times larger market. With regard to AI, I do think that the business models need to evolve. You know, you can't just charge $20 a month. I mean, really AI, agentic services, but the market ends up being huge because in the U.S., it's really making 130 million existing workers into super workers. I mean, that's a several $1 trillion market just in the U.S. alone. So I think there's still opportunities.
Tom Lee opens the conversation by reframing what many investors think they already understand. Instead of focusing on recent price action or short-term volatility, he pushes attention towards scale and adoption. His warning about 2026 is subtle but clear. Investors who confuse early saturation with maturity may miss what comes next. This sets the tone for a broader message about growth, valuation, and a coming reset in expectations.
You know, I think the AI trade, I mean, it's been a juggernaut, and we know that the visibility for the next few years is really good. But now investors are just trying to figure out how much to discount, you know, what's the appropriate price to put. And that could drive some profit taking because they've done so well this year. On the crypto side, I think that there has been some concerns about, quantum. And then there was that huge deleveraging event on October 10th. But the crypto fundamental story, I mean, is exiting on a really high note this year.
Here, Lee lays out the tension building beneath the surface. Both AI and crypto have strong fundamentals, yet investors are growing uneasy. The fear is not collapse, but deceleration. This hesitation is exactly what Lee believes will define the lead up to 2026, a period where sentiment and fundamentals temporarily drift apart.
I think we're in what I'd call the bleeding edge phase, like where everything feels like the tech is in front of the applications. That happened in mobile, which I studied for 17 years, and in internet early days. You know, like when color phones first came out on mobile or even keyboards, people kind of sneered and said, you know, who's going to be using a color screen? And remember famously what happened when the iPhone was launched and how one of the biggest competitors dismissed it and saying it's just a toy.
This historical analogy is critical to Lee's warning. Investors often mistake unfamiliarity for failure. The same pattern appears again and again. Early skepticism gives way to mass adoption, and valuations change dramatically in the process. Lee suggests 2026 may be when this transition becomes impossible to ignore.
I think we're at that phase with AI where the capabilities will blossom and then services will follow. But that, as you know, the future happens faster than many expect.
This short but decisive statement carries weight. Lee is not predicting gradual change, he is signaling acceleration. The implication is that markets may not have enough time to reprice risk and opportunity smoothly, creating sharp moves that catch investors off guard.
I believe that AI stocks, especially stocks like NVIDIA, are going to actually re-rate higher. Because if Walmart and Costco trade at 37 to 45 times earnings because they're predictable, then NVIDIA shouldn't be 27 times.
Valuation is where Lee's 2026 outlook becomes more concrete. He challenges the assumption that hardware-driven AI companies deserve lower multiples. His argument reframes predictability as the key variable, not sector labels. This is where he sees a structural repricing ahead.
I also think the banks are really criminally undervalued right now, like a JP Morgan, because that's becoming a technology company. And in the past, people are stuck in the head that it should trade at 1 times book or 10 times earnings. I mean, they should trade more like a tech stock. So
Lee expands the warning beyond AI and crypto. Financials, particularly large banks, may undergo the same reevaluation. By 2026, the line between tech and finance could be far thinner than investors expect, reshaping sector leadership across markets.
As many technical strategists will tell you, it's actually sometimes better to buy things at all-time highs.
This comment hints at behavioral traps. Many investors wait for pullbacks that never arrive. Lee implies that the fear of buying high may prove more costly than volatility itself as structural trends continue to unfold.
That's right. I think 2026 could look like this year because this year had a bear market and then a bull market. Next year, there is two puts. There's the White House put still in play, and the Fed put, I think, is going to come back. People sort of forgot, like it's been dead for 3 years. It's really going to come back in force. But it will take maybe the first half of the year to get through that because we don't have a new Fed in the first half. So I think the first half next year could be down 10 to 15%, and then a big recovery.
This is the clearest warning in the discussion. Lee is not predicting a straight line higher. He expects turbulence, drawdowns, and renewed policy influence. For investors looking toward 2026, timing and patience may matter as much as conviction. Throughout this conversation, Tom Lee outlines a future that challenges surface-level narratives. He argues that skepticism itself may be the fuel for the next phase. Artificial intelligence, crypto, and even banks are not nearing exhaustion, but approaching transformation. His warning about 2026 is not about collapse, but about misreading where we are in the cycle and underestimating how quickly perceptions can change.
Well, MSCI is important because other indices follow suit. MicroStrategy is building a digital credit company, so I think investors will still support their efforts. But of course, I think they can be very persuasive. But the DAT world has many companies. A company like Bitmine is already becoming more of a bridge to Wall Street and investing in DeFi, so it's becoming more of a financial infrastructure company. I think DATs are going to be more of a generic word like REITs next year.
If Tom Lee is right, and